today we have the pleasure of being able to bring you a webinar series on the topic of the recent federal tax changes and impacts of the latest federal budget that came down. We did see some reprieve from those tax changes, but Ron Friesen is going to walk us through that a little bit. And as you know, as FNA members, you have many different opportunities to get value out of your membership, be it through our preferred supplier program, and with that, of course, access to AgriCity's complete portfolio of products. And like I say, today we have the opportunity for you to get some extra value through the ability to deliver the foremost experts in a range of topics. And so today's, of course, is on tax changes and the recent budget, like I said. So before we get going, a few housekeeping items just to take care of. You'll notice that you'll have the ability to type in questions through the chat function on the webinar. You can type those questions to everyone to make them public, but should you want them to be private, you can also send them to the organizer, who will then moderate the questions. And so, yeah, please feel free. Now, as far as questions go, just to manage, what we'd like to do is to, you're welcome to type in questions as you think of them, as they come up, but we will be addressing them at the end of the webinar, and I should say Ron will be addressing them at the end of the webinar. We have it structured as such that we'll have plenty of time to answer at least a couple of those questions, and if you did sign in with your name when you entered the webinar, we can definitely reach out to you afterwards to get you the answers if we're not able to address them during the presentation. The other thing I should note is we are recording this webinar, and we will be archiving it and uploading it to our YouTube channel following the presentation. So just so that you're aware, you can log on to our YouTube channel and attend and take the webinar in afterwards as well. So I think that takes care of all of the housekeeping items. With that, I would like to introduce our presenter. And I should also say myself, I'm Blake Byseth, Member Services Manager with Farmers in North America, and I've just been helping to coordinate this webinar. But we do have Mr. Ron Friesen. He's a partner with Myers North in the Saskatoon office, and he's got 28 years experience in the industry, working with small businesses and farmers, especially, and dealing with tax issues and really just tailoring their services to what your needs are as a farmer and navigating through that. So with that, I will pass it on to Ron, and again, be sure to type in your questions, but we'll take those at the end of the presentation. So thanks very much.
Thank you, Blake. Welcome, everyone. Hopefully you find this helpful and interesting. I'm a tax partner, so obviously I find this kind of stuff fairly entertaining, but we'll see what we can do as far as entertaining you. So there's been a lot of activity, obviously, in the tax world over the last 12 months, I guess more in the last 8 months or so. Budget a year ago, then some summer announcements that were pretty dramatic. A bunch of pullbacks from that last December, and then actually, believe it or not, another budget here right at the end of February. So if you look at the agenda there, you see we're going to go through and list off some of the changes that have happened over the last couple of years. Talk a little bit about how they will impact the farm community. I'll briefly discuss a little bit about what they had actually proposed last summer that didn't happen. Maybe predict a little bit about what they may think about doing in the future. Talk a little bit about some planning that may be a little more urgent given what's happened over the last 12 months. And then, yeah, we will talk about the budget, the 18 budget, the federal budget that was just released a couple of days ago. For Saskatchewan people, there's a little bit of news that came out here just started this week regarding PST, and then just a few points on some planning for 2018 and forward. So what did we learn from the summer of 17? So here's some of the stuff that happened, some of which was actually prior to the summer, but here's kind of the events that took place over the last little while that have a significant impact to producers. So back in 15 and 16, there was some rumors and discussion around the whole concept of how the sale of production quota was going to be taxed. It was introduced in the 16 budget as the actual changes with a consultation period, but very limited input was provided from ag groups in the ag sector. It was introduced as a simplification of the tax system. And then in the 16 budget, they actually finalized the legislation with implementation January 1 of 17. And so those are now live and living, and we're actually filing tax returns here for 17 already with the impact being felt. Specified corporate income was also another area that the government introduced, and that again was in the 16 budget. In that case, there was no consultation period at all. The legislation was live and at that point of the budget and started that date. So, and we'll talk a little bit more about that specific topic here in future slides. Then in the budget of 17, the government put out a feeler on deferred grain tickets. So they kind of introduced the concept of maybe eliminating the ability to defer grain tickets. They opened up a consultation period initially till the middle of May, which was right in the seeding time for most farmers in Canada. They extended that till later on in the summer. There was a significant lobby effort that was put forward by a variety of parties, including MNP, and then the government actually abandoned the change in the fall of 17. Then July of 17 came along, and they really took a stab at making some huge changes. We'll go through some of the details here later on what some of those categories are. Tax on split income was obviously one of them. That's the whole concept of sprinkling dividends to shareholders in a company. Accessing your capital gain exemption was going to be significantly pared down for any gains realized before somebody turned 18. And then conversion of the extraction of money from a company from dividends to capital gains was something that they were really excited about and decided they were going to try to eliminate. They had a rather short consultation period, so this came out in the middle of July, so right in summer. And I don't know if you're watching the media or not, but there was very limited kind of commentary on this initially in July and August, but as soon as September hit, the media really started to focus on this. There was a significant amount of lobby efforts put forward. In total, there was over 21,000 submissions made by, I believe it was about the end of October, which was the deadline. And there was a lot of submissions from ag groups, so both various ag lobby groups as well as accounting firms like ourselves. And then mid-December, the government started to pull back on a lot of the things that they were proposing in that July period. And so at the end of the day, really the only change that moved forward was the tax on split income rules, which are now up and running, and they are effective January 1, 2018. And then during that time period when they were pulling back on a lot of the proposals from July, they actually threw a bit of a surprise in and said, oh, and by the way, we're going to lower the tax rates for companies, partially maybe as a reply to what they knew the U.S. was doing with their corporate tax rates. And so, of course, there was a lot of fanfare around the fact that they were lowering the corporate tax rates. But about a week later, they also announced that, and in a much more silent method, they announced that with the coordination of the lowering tax rates, they were actually increasing personal tax rates on dividends. None of this was ever consulted on, and so the net result is, as you can see there, the dividend tax credit personally was being dropped to kind of correlate with the fact that the corporate rate was dropping, to basically end up with the same total tax burden. However, the little secret that's inside of there is that any payout of dividends from your old equity, we're now going to be taxed at a higher rate in essence, because they have not benefited from the lower tax rate in the corporation. So for example, my example there shows that $1 million of old equity, if it's paid out under the new dividend tax rates, you actually pay about $20,000 more in tax. So in reality, through all that smoke screen, it was really a rather significant increase in taxes, not a lowering of taxes in the long run. So what did we learn? Well, obviously, without a lobby effort and 21,000 submissions and all those types of things, I'm thinking a lot of these rules that they were proposing in the summer probably would have actually proceeded forward. So it's important to get involved. And I think a lot of farmers are members of various organizations and all that kind of stuff. Farmers in North America are obviously involved in that kind of stuff. So I think it's important for farmers to make sure that they are tied into some kind of a farm lobby group, just to be aware of what's going on, and then and these groups then need to be available on short notice to make sure that they are providing feedback to the government when proposals like this are being made. And then the next goal really is to maybe avoid some of the things that happened during the summer by being a little more involved with the Department of Finance ahead of time, to make sure that any kind of legislative introductions are a little more well thought through before they are actually released. And you'll see in a bit here when I talk about the 18 budget, it seems to be something that's happening, because they've definitely been, it appears from what they introduced here in the 18 budget now, they've been a little more involved in listening to what tax planners and people in the know kind of feel as far as what tax policy should look like. Yeah.
We're just going to try one thing quick. I understand you can see both the current slide and the next one. So not a big deal. We'll just proceed.
Keep going. Okay. Okay. So yeah. So let's talk about then what kind of is left and what impact this will have on farmers. So specified corporate income has remained as an issue for farmers. So what that does is, if you generate income in your company through the provision of services to another company that is owned or has an ownership involvement by family members, you won't be able to use your small business limit on that income. So for example, you've got a farming company that owns a sprayer, and you custom spray for your daughter or son's farming company. In a case like that, you're going to have to do a calculation on what profit you generated from that service to the second company owned by your children, and potentially, unless they share their business limit with you, you're going to have to pay the higher corporate rate on that income. Another example is selling grain to a terminal. I know the terminals have been working on this significantly, trying to change this, but as it sits right now, if your farming company sells grain to a privately owned terminal where somebody in your family member has an interest in, you potentially won't be able to use your small business limit on that income. So as you can tell, as we start filing, this was effective for year-end starting after the 17 budget. And it's live and up and running now, actually 16 budget. So it's live and up and running now, and we're actually filing tax returns and having to grapple with this issue. And obviously with a cash basis grain farm or cattle farm, it's a little more difficult in calculating what is your actual taxable income, for example, on a sale of grain to a private owned terminal. Tax on split income is now up and running, so effective January 2018. This is something that farmers will have to deal with. So in essence, what this does is it taxes dividends at the very highest rate personally, unless the dividend is reasonable for the services provided, in essence. There are exceptions, and in most cases, like I say in the last bullet there, in most cases farmers will be exempt from this legislation, but I think as we're working through some of this stuff, we're finding more and more that there are cases where we're going, oh, well, potentially, maybe we are caught here. They focus on service industries, so a farming enterprise is probably not providing services. However, if you're crop spraying again, that potentially would be a service, and so the rules are tighter for service businesses. As you can see there, 10% of ownership is required. That's direct ownership, not through, say, a family trust, so that can create some headaches. And then holding companies are a whole other structure that maybe needs to be looked at. There is, you do have till the end of 2018 to change your structures or work with your structures to make sure some of these rules are met. So there's some time to kind of take a look at it and make sure you don't have an issue, but it is live and up and running now and something that needs to be addressed. Passive income, in the summer of 17, they announced that they were hoping, or they were thinking about changing the rules significantly on how passive income is going to be taxed. And basically it was expected that in the budget from earlier this week that they were going to announce these changes, and it was potentially going to be very tax ineffective to have investment income inside of a company. There was some verbal assurance given that the old equity would not be impacted. And I'll go through this a little bit more in the slides related to the 18 budget, but we now know what these rules look like, and they actually are looking significantly better than what was initially thought to be coming. So again, production quota sales, so that's left, and it will impact farmers, anybody in the supply managed industry. These rules are up and running as of July 1 of 17. When under the old rules, generally sale of some quota was not creating a tax burden until the final sale of your last large quota. Under the current rule now, basically every sale generates a tax liability. It has to do with the averaging of the cost base and identifying that if there is a gain on the quota from what the average cost base is for the farmer, right away there's income that's got to be reported. And as you can see, the other thing they changed was the tax rates on that income are very high. So 51% on half of the gain is taxed, or it's taxed at 51%. There's a refundable component there, but again, the cash outflow can be considerable compared to what it would have been under the old rules. And then the other thing that's a bit of a surprise in there that people weren't maybe aware of is that under the old system, replacement property rules could be used to eliminate the tax burden entirely. If somebody was just moving provinces, let's say, and starting up a new dairy farm, for example, under the current rules, the CRA's position is that the replacement property rules do not work. So I think that's an example of where there wasn't a lot of lobbying done in this space, and as a result, the rules that they were contemplating implemented got implemented, and now we've got the much more taxable system in place. How bad could it have been? So here's some of the stuff that they were proposing to do that they've abandoned, and I got a question mark saying there, are they abandoning it for now, or is this abandoning this forever? I guess time will tell. But they were talking about not allowing farmers to use their capital gain exemption on gains that were accruing prior to age 18. And there's going to be a lot of work that would have to have been done to come up with what was the value of the land at the point in time when you turned 18. There was some bump options they were going to give us for the 18 personal tax returns, which would have created a lot of work and a lot of headaches, I think. But again, that was abandoned, so everybody's kind of happy about that. Deferred grain checks. Again, they completely abandoned their proposal to eliminate that option. Questions that were presented to them with respect to this proposed change focused around the fact of, the deferred grain check system allows farmers to deliver grain more evenly throughout the year, and if that was removed, you know, how is that going to impact the delivery system? You know, and I guess the other question mark there, was this a bit of an attempt or a warning shot to say, you know what, we're looking at maybe eliminating the cash basis of taxing farm income? Time will tell, I guess, on that. Capital gain conversion to dividend, again, is something they abandoned. But there was significant, in the tax world, the tax planning world, there was significant fear as a result of the July introductions from the government that potentially things like farm partnership and corporation plans were going to be heavily impacted by this. One of the big lobby efforts focused around the fact that it would be significantly less taxable on if a farm were sold to a third party as compared to a farm sold within a family member or family unit. And so I think, again, the government listened to some of this stuff, and like I said, it was abandoned. And then there was, under the specified corporate income rules, initially, it was the fear that all the supply managed industries, who basically always sell their product and don't have an option to sell their product to anybody other than the cooperatives that they are owners of, potentially they would not have been able to use their small business limit any longer on any of their income on their milk and egg sales. And again, the government listened, and they changed the legislation so that these industries are not impacted by that. So what is the government committed to in the future? Passive income rules, again, in the July release, they identified that they were going to potentially change some of this. There was, again, significant lobby effort put forward to identify to them that what they were proposing potentially was hugely unfair, and they've actually listened to that lobby effort, and I'll go through kind of what they ended up doing in the 18 budget slides in due course here. Future changes, maybe they've talked about related party succession and trying to make it easier for farmers that are now, you know, a lot of farmers are incorporated and using a little more complex structures maybe than in the past, given the size of farms and the value of land and all that kind of stuff. So they have verbally acknowledged that they are looking at maybe making it easier for farm families to transfer farms through to the next generation in situations where they have incorporated. They're very afraid of the fact that if they open up the rules, potentially there would be abuse of those rules. So I think if they're going to do something here, obviously they're going to think about it long and hard. They gave verbal kind of words to this, but there was no mention of it whatsoever in the 18 budget that was released here a couple days ago. There was a private members bill that was introduced in 16 to try to alleviate some of this stuff, and that was shut down. So who knows what's going to happen in the future. Should we be delaying succession plans? Well, I wouldn't be holding my breath on this one, I don't think. So if there's planning being implemented at this point, I'm not sure that I would be suggesting that people wait to see if the government's going to make any changes here. Producer-owned terminal and SCIs, or specified corporate income, the Department of Finance again has verbally identified that they were really not intending to catch this in this legislation. That's the most we've heard of so far. So we're watching and listening closely to see if something happens. But obviously we're right now in the filing periods for a lot of these corporate year ends where this is impacting them. And so far the rules haven't changed. So right now we still have an issue with grain sales to producer-owned terminals. And then the whole kind of issue about how do we calculate what that net income really is. And there was no mention of this in the budget of a couple days ago. So as of right now, this is still an issue that has to be addressed by farmers. So again, some of the questions that maybe are being posed right now are, you know, are some of these long-standing farm rules at risk? The industry has changed significantly over the last generation between the size of farms, the value of farms. There's been a lot of things that have changed in the industry. And some of these old rules that were put in place when the tax legislation was initially introduced, they were put in place for a very different economy, a very different industry. And so there's definitely is some concern that the government potentially is maybe taking a look at some of this stuff and wondering whether the industry has changed enough so that some of these rules should be tinkered with, at least at a minimum. Things like cash basis taxation, tax deferred intergenerational transfers. Again, given the values that are there right now, the tax advantage that a farm family can realize on the transfer to the next generation as compared to any other business, the actual tax deferred is the number is growing significantly, but given the values, which would give you another reason to say it should continue that way, because in order for a family to pay the tax that potentially is being deferred, there would be a lot of sales that would need to take place of farm assets. Will they ever tinker, like they were talking about this summer, with the ability farmers have to use their capital gain exemptions when they incorporate their farms? Possibly. And even maybe, like I said, in that they were proposing to tinker around with the rules around capital gain exemptions on land and such assets for individuals during the time period they were under 18. So anyway, it's an interesting time when it comes to the farm tax planning right now. There's been some scares, most of which have not been moved forward, but there is some thoughts and discussions around what is that just some indication of what may be coming down the road. So as a result, is there a renewed urgency for farmers to kind of finalize some of their tax planning? Possibly. So, for example, should farmers maybe think a little bit more about whether the use of the deferred grain tickets is something that may be eliminated at some point, therefore maybe become a little less reliant on that? Should some capital gains maybe be triggered so any rule changes would not impact farmers? Should capital dividend accounts be paid out that are inside corporations? Again, that was an area where the government was proposing last summer to maybe eliminate. And maybe succession plans, maybe they should become a little more urgent as far as implementing and using the tax rules that are there at this point. I'm not trying to be scare tactic here or anything, but I'm just telling you what happened last summer and over the last number of years. There is a question being raised about whether there is some incentive by the government maybe to take a run at some of this stuff. So let's talk about the budget of 18 that just came out 2 days ago. So on the 27th of February, as promised, the government did address the passive investment income that companies realize. However, they didn't change the tax rates on the income being realized. So that was, as tax planners, I think anybody that I've talked to seems to feel that the conclusions and the plan they came in to play with here now makes a whole lot more sense than anything that they were proposing last summer. So in essence, the summary of the changes are the fact that there is no rate change, so that income still gets taxed similarly as it was previously. The only real impact that's going to happen is for any company that earns income from passive assets over $50,000, basically government saying if that means you've got about $1 million of passive assets sitting in your corporate enterprise, that probably means that you don't need access to your small business limit. So they're going to grind your access to your small business limit so that if you earn $150,000 of passive investment income, your limit will be entirely gone. So between 50 and 150, they'll gradually eliminate your 500,000 small business limit. So like I was saying, it appears the government's been listening to knowledgeable advisors and come up with a solution here that actually has some practical sense to it. Obviously, there's going to be lots of questions. This is all brand new. It's to be implemented effective year ends that started after January 1 of 19. So we've got some time to kind of understand the legislation and then plan with clients if this is going to impact them. Definition of what is included in passive income is obviously going to be a very key factor. And then potentially there's going to be some advice given to clients about how to move income or move assets out of a company to avoid this issue. Most of which, like taking money taking money out of a company obviously is generally very taxable. So the question, you're going to have to debate whether you pay the tax, get the assets out, or are there some other things we can do to make sure that this doesn't create a problem for us. But again, as a kind of an overall summary, I think it's something that's a fairly reasonable conclusion to the whole passive investment income issue that the government had identified. The other little tweak they made in the budget the other day was getting access to your refundable dividend tax on hand. So that abbreviation there stands for refundable dividend tax on hand. It's a tax that you pay when you have investment income or if you realize capital gains on the sale of land and other assets. And basically what they're trying to do is they're trying to streamline the fact that you're only going to be, the triggering of a refund of your refundable dividend tax on hand is done through a dividend to a shareholder. And in the past, under the old rules and the rules up till the end of 2018, it didn't matter what type of dividend was paid, whether it was eligible or ineligible dividend, it triggered the RDTOH refund. And so they're just paring it down to say, let's force companies to pay ineligible dividends, which are the dividends that are realized generally on passive investment income. Let's force shareholders or companies to pay dividends out of that tax bracket to refund the RDTOH instead of being able to use any dividend to refund that. Something that we're going to have to watch a little bit just to see, and again, this is all brand new legislation, but one of the things we're going to have to watch is whether there's going to be a situation where we might have some RDTOH trapped inside of a company. So that's one thing obviously that we're going to have to watch closely. And believe it or not, that was basically it. So hopefully maybe some of these major changes, we're through them now, and we can maybe plan, given the rules that are now all put in place and effective, maybe we can now start a more streamlined planning where we know what's coming and we can plan accordingly. For those of you that are in Saskatchewan, there was one other brief announcement. There is a budget coming in Saskatchewan next or later this month. However, the new leader of the Sask Party did identify in his campaign that he was going to eliminate the application of PST on insurance policy premiums. And he's actually done that, and it's retroactive to back when this was introduced. So for a farmer, that's going to mean your crop insurance premiums, your life insurance premiums are not going to attract a PST tax on top of the premium. So that was good news for Saskatchewan farmers. And the way it was introduced, I believe you'll actually be getting a refund of your PST that you might have paid last year. So as the last little bit here on this, why don't we talk about a little bit of a few points for some tax planning for 2018 and forward. So obviously one of the main things is the new rules are now in place for the tax on split income dividends. So everybody should be taking a look at their structures, making sure they have the proper share structure in place to avoid the issue if possible. And then obviously, if you've got a spraying business or something like that, the rules are a little different for you, and you're going to have to take a little closer look and maybe just plan accordingly. And again, we're thinking most active farm families will not be impacted significantly by this. However, that doesn't mean that you don't need to take a look at it and maybe just tweak where your dividends are coming from and maybe tweak the ownership a little bit just to make sure that you're not impacted. The other the other thing that a farmer should be doing is making sure they're tracking the hours of those people that are not as active. Like if somebody's full-time farming and that's all they do, obviously maybe the hours aren't going to be that important. But if there's somebody that's close to the 20 hours per week threshold, probably it would be a good idea to kind of document what that person is doing and how many hours they're putting into the farm. Possibly, maybe, given some of the things that happened over the last year or so, maybe try to become a little less reliant on things like deferred cash tickets and just the whole entire cash basis of taxing income for farms would probably be good advice. So maybe pay your taxes at a reasonable level of income, possibly incorporate to take advantage of those new tax rates that are coming on stream here right away. So obviously that's probably generally good advice. And then, yeah, so like I was saying, take advantage of the lower corporate tax rates. In Saskatchewan, by the year 2019, our rate's going to be 11%. Every company that's not associated with other companies gets a $500,000 limit per year. So thinking about being involved with using that limit every year is something you may want to think about. And then in Saskatchewan, in last year's budget, they actually introduced that the provincial budget, or the provincial limit for the small business threshold is going to be 600,000 starting in 2018. So potentially maybe using the 600,000 limit in Saskatchewan is maybe a wise thing. And believe it or not, the income between 500 and 600 should result in something called an eligible dividend pool, and the flow through and all that would be at the very lowest tax rate possible. So it's probably a good threshold to use. Another thing to look at is just analyzing the new passive income impact on your small business limit. And again, doesn't apply till 19, so that gives you some time to take a look at your situation and identify whether there's going to be some issues in your case or not. If it's going to impact you, potentially there are things that you can do to make sure it doesn't. So possibly maybe you want to take passive investments out of your company through some method of taxable extraction. Possibly maybe one option would be to move some farmland in and take your investments out so you're not impacted. There'll be a whole bunch of different things that people will be able to do potentially to eliminate or remove the impact of this. But again, we'll take some planning in some cases. And then obviously there's those new rules in 19 regarding recovering your RDTOH. So maybe 18 is a good year to do certain things to recover as much of that as possible while still under the old rules. And then one of the other things that we're finding, given the a lot higher values of farmland and farm equipment and everything, is we're starting to see companies have their business limit ground down by the fact that their capital is in excess of $10 million. Obviously a larger farmer, but nowadays this is actually not that large of a farm any longer. So that's something to monitor. If you see that it's going to become an issue, maybe it'd be wise to make sure you use your limits while you have them. Take a look at your structures, and if you're going to combine farms to generate economies of scale and all that kind of stuff, make sure this is an issue that's thought of and addressed in your plans as to how you actually combine those farms. And just taking a look at it and making sure your tax advisor is aware of the fact of what you're doing as far as growing your farm and all that kind of stuff, to see when and if this is going to become an issue. And if it's potentially going to become an issue, what can we do to make sure it's not an issue? So yeah, that's kind of a 40-minute summary of kind of some of the things that have happened over the last 12, 14, 2 years kind of thing. It's been very, there's been a lot of activity, lots of changes. It's creating, a lot of planning opportunities for clients that maybe you didn't have to worry about earlier on, but now all of a sudden has become an issue. And so, again, it's always good to be on top of things and to have those discussions. Some of these things won't impact you at all, and it might be a 5-minute discussion with your advisor and the conclusions reached that you're not impacted, but there's going to be a lot of people that will have some impact of 1 or 2 of these items. And with a little bit of planning and advice and some work, you potentially maybe can make sure you can work your way around what the new rules look like. So this slide here just shows you if you feel that you need to have some further advice on this. There's our website, and obviously pretty easy to find out where we would have an office. And so at this time, if there are any questions, we're just gonna coordinate a little bit here to find out what those questions look like and maybe answer a few. And again, if you need to, if you have other questions that you haven't thought of while you're on the session, don't be afraid to get a hold of somebody like myself.
Yeah, so I'm just gonna step in here quick. I'm just kind of looking at the chat feed, and it doesn't look like there has been any questions just yet, but I know there's been a lot of information for sure, a lot of good things to chew on there. So I imagine you all are just kind of thinking it over right now. I will just kind of walk through a little bit of closing, housekeeping items. And if you're thinking of any questions, you can definitely type them in the last couple of minutes. But again, we gladly welcome any feedback you might have on this webinar for sure. We'd like to hear how it went, anything we could do different, as well as if you have any other future webinar ideas for topics. Definitely we gladly take that in and see what we can do for you as our members. So feel free just to call into the head office or send in an email, or reach out to me directly, again, Blake Wyseth, and we'll consider that too. And just a reminder that the presentation is archived, or it will be archived as well, not long after we get it wrapped up here. So you'll be sure to get an email letting you know where you can find that shortly. It'll be on our YouTube channel. Again, just kind of looking through the chat feed, doesn't look like we have any questions just now, but like I said, chew that over, and for sure don't hesitate to reach out to Ron or to FNA there. And with that, yeah, I would just like to thank Ron for coming, for being willing to share his expertise on this. Gave us a lot to think about, and really appreciate the considerations for planning for the 2018 year there, especially as well. So with that, I think we'll close our webinar, but thank you everyone for taking this in.
Yeah, thanks everyone. And like I said, if you need to get a hold of anybody, you know, there's our addresses and stuff around there. So feel free to touch base. Thanks again. Sure.